Okay, hello everybody and welcome to another Learn It Live webinar. Today we're going to be talking about the three key pillars of Forex trading. And it's going to be a really good lesson for everybody to learn, and there's a lot of great information in this particular webinar to unpack. So my name's Thomas Atkinson from FX Evolution. As always, I'm joined by Tyrone Abella. How are you, Tyrone?
Hi everyone, and welcome to tonight's edition. We're getting plenty of market action, so hopefully we're going to jump into some live charts as well and talk about the pillars that we're going to describe in tonight's webinar.
I must admit, I was just looking at the Euro US dollar, so before the webinar, so it almost distracted me there. But look, hopefully everybody can hear us. Could I get somebody in the room just to let us know that they can hear us and that everything is working before we get started? It's a little bit delayed there. Thank you very much, everybody. So just a quick risk warning, the information contained in this video is generic in nature and for educational purposes only. The information does not take into account your personal objectives, financial situation, or needs. This information is not to be construed as an offer, recommendation, or solicitation to buy, sell, or participate in any particular strategy, of course. So firstly, Ty, I just want to talk about the Telegram and now Discord group. So basically, there are two groups now. There's the Pepperstone Telegram community, which is excellent, and that community basically gives you daily updates of all snippets of information, and we highly recommend that you check that out, and we will post a link if you haven't already done that on in the chat right now for everybody to look at. And we've recently moved our community from Telegram into Discord, and we will post our new free link for the public chat there, and that's just to allow everybody to have discussions there. And it was getting a little bit crowded in the other one, and just kind of split it up, which is nice. So yeah, two communities achieving slightly different goals, and Telegram is still the one that, of course, we're recommending in terms of if you want to get the snippets of information, more information about our webinars, more information about Chris Weston's stuff, and everything else that Pepperstone is doing. So what are we going to be covering today? Well, quite a few things. We're going to be covering how to identify a market trading theme, very important as we're seeing changing themes week to week at the moment. Why economic news impacts and move currency pairs, which will be very, very good to check out. And also a lot of people don't seem to understand necessarily what the economic news really is doing and why currency pairs move the way they are. Sometimes you'll ask that question, well, I thought that this would do something, like let's say they drop interest rates, and then you think, oh, okay, well, I think that should mean that currency weakens and it strengthens. It's because of the statements behind that, and also because price is packed in over a series of events, and we'll talk about those events. Specific technical patterns to keep an eye on. Obviously, there are many different patterns. We're going to talk about the best ones to look at and why you should use those. And then, of course, live Q&A with our team. So everybody, if you have questions, please ask them during this webinar. We'll answer as many as we can during the webinar. And of course, we'll answer some key ones at the end as well. So we always get asked this question, and that is what trading pairs are best to start with? Look, there's always kind of like the blue chips of, let's call it Forex. And those are gold and the relative different pairs. And I believe Pepperstone might have a couple of different golds now, which I haven't taken a look at yet, which is excellent. And then, of course, US dollar majors, things like odd US dollar, Euro US dollar yen, pound US dollar, and then some major crosses. So things like Euro pound, Euro yen, pound odd, etc. And if you're going to be a scalper or a day trader, you probably want to figure out what time zone you're in. If you're in Australia, focus on things like the yens, the Aussie, gold, which trades very well during Asia, and maybe the pound odd.
Okay, so times of the day to trade is a really, really important thing for the group to know, because if you're trading the wrong pairs at the wrong time, you're not going to get the movement that you need. And sometimes even the spreads are actually quite nasty. Like they can be, the liquidity is low. That's one of the biggest problems. So if you're going to trade, say for instance, as an example, the pound euro pairs, as you can see here, or even the Aussie yen, in the middle of a New York session, you're not going to get the same effect as you would as if you trade it in the daily session of the Asian markets, because obviously it's going to gravitate to the more refined market that it's actually exposed to. So the pound euro, obviously it's going to be better in the London markets. It's still going to be pretty good in the New York as well, but it's going to have its most power in the London and European markets. So by being aware when you need to actually get in and trade at that time, it's going to give you the best chance of the market, one, to actually move in a reasonable direction and have enough flexibility, but also the spreads are going to be a fair bit tighter because the liquidity is there, so you're going to have no problems with fills, and you're obviously going to have no issues with getting in and actually hopefully getting the move that you want. There's nothing worse than being stuck in a trade and it not moving anywhere. You sit there, you're waiting for it to move, and you're thinking, yeah, what it does, it's actually a time vacuum, because what you'll do, you'll sit there and watch it, waiting for it to actually place, move even a little bit in your direction. And you could be waiting for hours, and you can see all you have to do is actually go back through the charts and isolate the different time frames. Like say you can do vertical lines on the different sessions, and you can see the differences in movement. So it's really, really important to understand which time frame that you're working on compared to the pair that you're actually doing.
Is this any better? Hopefully it is. No better?
It's better. It sounds a little bit better, yeah.
Okay, well, we'll have to go with this. Look, we've been doing this for well over 3 years, and I've never had a problem with the mic, so that's interesting. If it is okay for everybody, that's good. Basically, what I want to talk about in the first pillar tonight, Ty, is identifying a theme. Now, we always talk about the top-down approach, and there's a great question for this from Adrian, actually, that's come in straight away, which is gold often trades with a wider spread, much easier to be stopped out or hit by stops before expected. Tips for trading with larger spreads. Well, I think the biggest tip for you, Adrian, is to look at the top-down approach kind of concept and to think about trades from the perspective of maybe a slightly higher time frame than you currently are. Now, I understand everyone loves a good scalp and everyone loves a good day trade, but spreads don't, like, as long as spreads aren't crazy, like, I mean, there was a time actually in the last couple of months where gold was, I believe, almost $2 in spread at one point there, where liquidity kind of dropped out of the market. So if it's, let's say, maybe 20 cents or something like that, it's a little bit big for scalping, move your strategy more to swing and day, and the spread won't really heavily affect your particular trade. So we'll talk about this top-down approach. We'll look at the live markets. We're going to be looking at the euro, and we'll do that in a minute. We'll also maybe take a look at gold as well. So first thing you want to do is start with a high time frame and then work down. Ideally, you'll be looking at around 3 times to 4 times the time frame that you want to trade to start with. So if you're trading a 1 hour, try to look at weekly even, and you'll see why in a minute. Recognize trending or range-bound markets, like we always talk about. Use lines, bars, and candle charts. Don't fall into the trap of just using one. Specifically, if you use line charts and bar charts on daily, weekly, that is the best place to do that, because that's where you're going to see a bit of a smoothing effect in terms of your support resistance and your overall kind of approach to everything. Obviously, you want to recognize price trends. In our course, we always recommend learning peaks and troughs and basically learning price action from a candle and price action standpoint and not relying on an indicator per se. But anyone can tell that, of course, this is an uptrend over here on the left, and this is a downtrend on the right. So things to look for when we're identifying a theme. Before we get into the market, we're going to want to look at a few different things. The first one is look at the major for that currency. So let's say we wanted to trade the pound odd. We're going to want to look at the pound versus US dollar and the Aussie versus US dollar first. The second thing we want to do is we want to understand the current trends of the US dollar index. Even though we might be trading the pound versus odd, it's very important to understand what is currently happening with the US dollar index and how everything is correlated. So we'll talk about that. Check then for the VIX, the volatility index, and then consider checking any other cross pairs, because sometimes if you might see the pound, you go check that pound out and you say, wow, pound looks really strong. Then you might look at the pound odd, which was your original target, and you might look at the pound Swiss, and you might look at the pound CAD, and you might say, wow, pound CAD has even better technical setup on it, and pound CAD could become the currency that you want to trade because it has the strongest setup for your rules. So let's now actually get into the market and talk about each one of these things. So firstly, I'm going to bring up the US dollar index. And for anyone that doesn't have that on their charts, what you want to do with MetaTrader is you'll have all these different things. US dollar index is the one that you're looking for. And if you don't have this, right click over here in the market watch and left click show all. And this will probably show up a few extras that even I don't have yet, which it did, which I knew: gold pound, gold, I think it's silver versus odd, and it looks like gold versus Swiss franc. So all those things are now showing up. So just sometimes right click, left click show all, and you'll see all these things. So firstly, what is happening here on the US dollar index? And actually, this is very interesting what's happening here. So we have a key level of support that I've already drawn up, and I'm going to highlight this key level of support for everybody. So we've got that 1 touch, the 2 touches, and now we have the 3 touches. And this zone we've been writing about in articles on Pepperstone's website every week. I've been talking about this quite a lot indeed. And I've been focusing on specifically kind of this area here, and then this resistance and this support. So it's interesting that we have now hit the 98.80 zone on the US dollar index. So the first thing that I would do in the morning is I'd always check this, because whether we like it or not, the US dollar rules so many currency pairs. So we've now identified a key level of support. Well, if this is key level of support, generally that will mean that the euro US dollar is at a key point of resistance. So here we have the euro US dollar, and we've got kind of that resistance in terms of body, a slight break over here in terms of resistance, and now through probably some news and some money flow, the market is actually looking to close above any other point. And if it did do this, it opens up a key level for us as traders. So the US dollar index, firstly, is showing us support. Now, if the US dollar is weaker, what does that mean about the euro? It means the euro is going to be stronger versus the US dollar, because as the US dollar index is made up, the euro is the biggest component of the US dollar index in terms of the counter. So this move is very, very interesting. Like we always say, Tyron, I'm not even going to tell you, what is the number one thing that you always want to be looking for here whenever you're looking for breakouts?
Yeah, well, first of all, you want to see price action start to kick up. So in the first instance, if it's sitting in the middle of nowhere, you can see very clearly here on the euro that we've got this hammer candle on the 200. So we'll point that out for everyone. It's about, yep, you can see that that's a pretty good rejection. It's starting to potentially work towards a higher high. Okay, so we've already got our series of a low, a high, a higher low now, confirmed by that big candle on the 200. So straight up, we're looking for a potential break, and what we definitely want to see is the close above this area. Now, until that happens, we've got to be really mindful. You can see the previous 2 potential breaks both rejected before the candle actually closed up there. So, had you traded that prematurely and thought it was breaking out, you would have been stopped out, because both of them rejected quite hard. But when you do get that close above this level, that's the signal that it has broken. It's broken properly. Now it has to be on a significant time frame, like the 4 hour, of course. Now, this resistance line is going to be there on the 1 hour, and it's going to be on a 15-minute chart. But we're going to ignore those candles, because a close of those candles are not going to confirm what we're really seeing. We need to see that really solid break. You can see, this is smashed straight into the 200 on the daily, and it's coming off it a little bit. Doesn't mean it's going to stop there, but it's still got a little bit of work to do. It has to maintain, this level above, sort of probably above the 110 really, and actually close above there at the end of tomorrow's trading, or early morning New York. When that happens, then we can be happy that the channel has been broken. But until then, we're basically waiting for a potential reversal, really, because that's probably what could be happening here. If it does happen to close up there and you think it's gone too far, which does happen sometimes, all you've got to do is wait for it to come back and either retest it or look for a series of higher highs and higher lows on a 4-hour chart or a 1-hour chart, and that will give you the information you need to basically take it long. And that's the ideal scenario.
So the first thing that we've done with these pillars is we've gone to the US dollar index and we've identified a key level of support. Then we usually will go to the euro US dollar as our first key area, and we'll see whether it's agreeing with the key level of resistance or support. Now, sometimes one will lead the other. So in this case, the euro US dollar is actually leading strength when compared to the US dollar index. Now, you can look at it one of two ways, and as Tyrone mentioned, it's all about daily close here, and it's all about confirmation. We're straight into a 200 moving average, which acts as dynamic resistance. And in terms of what we're looking at, we need to see a confirmation close. We also, at the same time as this would say close above, would be seeing a 20-50 cross in terms of EMAs on the daily. So when we put that together, what we can do is we can wait for the confirmation close. We can understand that the market will generally come back and retest the level, as Tyrone mentioned, which is the role reversal. And then when that role reversal happens, we can then get involved in the smaller timeframes. Remember, I understand so many people want to scalp, and so many people that come to this webinar want to trade day trade and those types of things. So this is about putting together the top-down approach to then allow you to get bias on sentiment. And when you know and understand the money flow and where the money is going, pretty much as this market closes, let's say it did this, once it gets above this 200 moving average, it highly likely fills the gap or the zone. Now, somebody mentioned this week gap fill, and I don't think they were using necessarily the right word, because a gap means that there's there's literally a gap in price over a weekend or over a close and open of a market or something like that. But what this is it's kind of like the free zone where the market gravitates to the next key level of support or resistance. So it gets past this zone. We know that it should go at least the distance of the previous channel, which is something we'll talk about a little bit later. And then this gives you the sentiment to be able to get through. It's a 200 SMA, by the way. Well, it should be 200 SMA. So basically putting together all of that, you've used the US dollar index, we've used the euro, and then I did mention the VIX. Now, the reason I say the VIX is because you still want to understand, is there volatility in the market? So right now, there is certainly volatility, there's certainly uncertainty, and while it doesn't look so like that on indices like the S&P 500 and everything keeps going up, it can all change so quickly. So that's why it's important to always check the VIX. And I think that if you understand, like if the VIX is up at 80, you probably need to kind of watch your trade a little bit more. If the VIX is under 20 and a normal market 99% of the time, what you're going to be doing is setting mobile alerts, setting email alerts, using the Pepperstone advanced tools, and effectively managing your trade without having to look at the charts. That's the ideal way of doing it, because really sitting there and watching the trade constantly, you're going to make mistakes because you are going to be your own worst enemy. So in terms of the first pillar, it's understanding what's going on in the market and understanding that you're probably going to be the worst part of your own trade, and therefore you need to step away and set those alerts. So understand the top down, understand the money flow, and move on from there. So just a quick question here from Matt. Actually, we'll answer that a little bit later, Matt, so thanks very much. It's just about CFDs, so we'll talk about that at the end. It's a good question for the end. I think Tyrone might answer it now. So the next one is news events and economic news, and how do we actually like break it down in terms of the next pillar? What are we going to do with economic news, and do we need to be worried about it as a trader? If you trade actually swing and you trade a larger time frame, e.g. 4 hours or daily, you don't really need to worry too much about economic news. And the understanding of that is, remember, everybody says trend is your friend. The richest people in the world always say, I follow the big trends. And they do so because, and not that many people are contrarian really when it comes down to the rich ones out there. And that's because when you follow the trend, you're basically following the news. You're following what the price action is telling you and what the money flow is telling you. So one of the most important aspects of forex is that monetary policy and interest rates pretty much are the two key things that will move currencies over the long term. If you see interest rate cuts and they continue to do interest rate cuts on that particular currency, it will generally weaken it over a period of time. Now, the understanding of basically what's going to happen in terms of interest rates coming in to the market and starting to cut, and therefore one interest rate gets cut and the market goes up and the forex goes up in terms of that currency pair, and you don't understand why. It's because of each piece of key news impacts a currency. So throughout a month and throughout a 2-month period, effectively you're going to have all these releases. You're going to have CPI, you're going to have GDP results, you're going to have consumer sentiment, you're going to have spending, you're going to have all these different things, new house build, sales, all those types of things. And all of these key bits of news go towards, let's call it the Reserve Bank of Australia in this case. We'll call it our central bank. They go towards the central bank, and effectively the central bank makes a decision on their current policy and their current interest rate decision based on all these key bits of news. So as these bits of news are coming out, they pack into the price. So let's say the news starts at the month and it starts poorly. We start moving down. The next bit of news comes out, it's poor again. There's hope and anticipation. Next bit of news comes out, goes down again. And usually the market will anticipate something. And when that interest rate, let's say they do an interest rate cut because the news was so poor, the market might even go up. And the reason it does this is because in the statement, not only did they cut the rate, they'll also say something like, oh, we're considering not doing any more rate cuts and this for the next 6 months or the next 12 months, and we're not going to do anything about it. This is the last one. They do that, and then all of a sudden the market will say, well, we actually thought fair price was here. Now we understand that there's not going to be any other changes, and we're going to push price back to where we think fair price is. And you won't understand that. You'll be like, how does that work? Why is that happening? And it's because every time this little bit of news comes out, it creates a picture for the market, and the market basically anticipates all of that and effectively sells it off. So that's, I think, the easiest way to probably explain it. Hopefully it makes some sense. But you shouldn't be afraid of little bits of news if you're a swing trader or a day trader, because if you're following the trend, generally the trend has already set an example of what that bit of news is coming out, and you need to focus more on the monetary policy and the interest rate decisions and at this stage, the chairman speaking about what they're going to do in the future. So hopefully that makes some sense. But basically, that's the big bit of news. Now, I've got a question here. What can you do about news on the weekends? If you're trading oil, absolutely, you need to be very well aware when they're having meetings. When OPEC's having a meeting and you're trading oil, you better be either hedged or protected or know that you are taking a risk, because they obviously fluctuate oil price. If you're trading a currency pair into an election, that's dangerous over a weekend, of course. If you're just trading into a standard weekend and you're concerned about it, you have two options. One, hedge your position. Two, close it and reopen it on the Monday. And you'll find that most weekends, there isn't actually that much gap in terms of there won't be that much move between the currency pairs. So you won't be missing out on that much actually to do that. But hopefully that does make some sense. So the key bits of news create a story leading into a major decision that are made by the central banks. And I don't think enough people mention this. May sound simple when you hear it, but not many people mention it. That leads me on to the next thing. So you must have your economic calendar, and you must understand when people like this guy down here, Chair Powell, he basically will talk, and what he says will move stock markets like S&P 500, because it's of course US. He'll move currencies, especially US dollar, and he will create the most amount of volatility around his speeches currently pretty much in the world. But if you're trading the Reserve Bank of New Zealand, let's say we're trading the New Zealand dollar, you better be aware of all of this particular bit of news, because if they make an interest rate decision or tell you something to the market where they say, oh, we're considering negative rates, it will instantly move the markets. And that kind of thing is the one type of trade I don't like being in. But in terms of little bits of information like CPI and stuff, generally speaking, it won't affect your trades. It will actually benefit your trades. So the next point before we go into some of the key patterns that we look for, Tyrone, is don't FOMO. I bring this one up every week, and I think I'm just going to have to during this period of time, because I understand there's a lot of volatility, and there's also a lot of chance that some people have lost some money and they try to chase it. And chasing money, Ty, is that the worst thing you can do?
Most definitely. And actually, we have to keep repeating it in times of volatility, because that's when people see the market moving really quickly and they say, well, I need to get on board with this move, or I'm going to miss out, or it's not going to come back for me, or there are all sorts of emotions. And and thoughts that go through your head, but it's very, very important to actually stick to your trade plan. If you do miss a break, or you basically missed an entry point because you weren't there, or it happened too quickly, you're just better off letting it go, because quite often what you'll find is you'll get yourself in a lot more trouble than you really want to, because it happens all the time where people jump on a moving train, and then the next thing you know, it reverses really, really quickly, because sometimes those short and sharp moves can reverse just as fast the other way. And a lot of the time, if you haven't got it initially and you get in too late, it reverses on you very, very aggressively. And there's nothing worse. There's no worse feeling, because then you think the market's against you, and then you try and go short, and then you'll go long again, and all of a sudden you've traded 3 or 4 times, and you've probably been stopped out 3 or 4 times. It's a very, very bad mistake to make. So it's very, very important to keep your emotions in check. FOMO is just one of the biggest downfalls of traders, especially at the start of their journey.
Okay, so things we talk about on this particular webinar, or the webinars we run all the time: role reversal, channeling markets. We're going to assume you know some of these things, or you found out about them. And then we also talk about the keys of several great patterns. Now, Tyron, if you could put in the room a pattern cheat sheet that we offer for free, you can definitely sign up and get that. Basically, that has a whole bunch of different patterns that we would recommend that you consider using as part of your trading system. Now, we always say a good pattern, or a good trend change, or a good candle, or any of those things is not good enough in unison. So it's not good enough by itself. So when it comes to a pillar or something that you're looking for, and probably the main third pillar would be, never have one reason to be in a trade. Always have between 3 and 5 reasons. If you have between 3 and 5 reasons, you effectively have a business plan. And we did an interview the other day with a gentleman. He was, talking about his successful trades, and he has many reasons to be in a trade. He basically says every decision he makes and everything he does is business-like. It's not emotional. It's not anything else. It's, I'm making a good decision for my business by putting my money into this trade. And if you think about it that way, then I think you have a lot of more success. So double bottoms, double tops, head and shoulders, they're only just the beginning of what you want to look for. So
yeah, absolutely. Yeah, and don't let anybody talk you out of thinking that they don't work, or they only work in hindsight. And there is a draw in hindsight. Like for all of you who have been following us for the last 2 years now, that's actually not true. But there's a lot of people out there, especially on social media circles, really bagging up patterns. But it's all about identifying the correct pattern at the right levels, and making sure you're trading it correctly. It's always better to obviously follow the rules, but you can preempt them. There's no question about that. They're not always in hindsight, which people who actually don't know how to trade will lead you to believe.
Okay, so before we get into the market itself, these are actually some of the key patterns that I'd be looking for. So things like ascending triangles, double bottoms, double tops, inverse head and shoulders, and head and shoulders. Specifically those 3. And the reason I'm going to say that, and channels, and that's because they're the easiest. They're the ones that mostly use horizontal support resistance lines. When it comes to starting, or even if you're an intermediate trader, or even if you're pretty advanced, the easiest trades will always come off the horizontal, and that's because they're the easiest to spot, and therefore that also there's a huge amount of money behind them. So if you have like a head and shoulders, inverse head and shoulders like this, and it has a perfect horizontal neckline, there's no ambiguity to it. A lot of people always say with technical analysis, oh, well, it's too hard for me to see it, and it's too hard for me to constantly use the same thing. If you use certain patterns and just have those in your repertoire, then you will generally do better. So as part of the third pillar, obviously, when it comes to patterns, we want those things. We also want to make sure we wait for confirmations. Remember, we're talking about that Euro US dollar, which we'll go back to now. And that Euro US dollar, we need to see a confirmation close. Now, it looks great right now, but this can all look very different tomorrow when we come onto the charts and we check out what is happening. It can look incredibly different to what it looks like right now. So when it comes to that third thing, we want to be able to see it. Now, another thing we're saying is, how do we pick the currency pair that we want to trade? Well, Tyrone mentioned before that we like a series of higher highs and higher lows, and we like to see that in a currency pair. So here we have the pound US dollar, and we know right now that the euro versus the US dollar is quite strong. So it would make sense that the pound should be quite strong. Is it looking as strong, Ty, by current price action?
Well, it's looking really strong because it's doing exactly what we wanted to do. It's hit the bottom of the resistance from below. It's come up, it's made the low, the high, right at the resistance. It's made a higher low, and now you can see it's broken through. And we've got the higher high, and now it's come back and retested from the top. So, and that's what patience will give you. Like if you you know, got a little bit antsy, you may have missed that trade, but it's a lot of the time on a good market, it will come back and let you back in.
So the reason I want to bring this one up is because this has been a key level of support. So I'll go to the daily quickly and just again identify a key level of support followed by another key level of support that then becomes resistance in the idea of role reversal. It weakens off and it breaks through and confirmation closes here. Then it comes back, tests that level, and now it's on the move up. So when it comes to identifying, you want to find those key zones, and then you want to draw a zone that you're looking at. So basically like an area that you're interested in, and then you set alerts for that area. Now, if you're not doing that, I think you are probably potentially wasting a bit of time in the markets. And the way I always draw an area, and this is something we get asked a lot, is I want to look at the top of the wicks. So here's my top of the wick. And then I want to also look at the main body area. And the reason, and I usually go in the middle of all those bodies with my line, and then that becomes my area. And the reason I do that is because, and I'll set the alert, let's say I see it here, I'll set the alert for the top of the area, and then I'll watch how the price is interacting on the smaller time frames and come back to it. So if I saw a bullish hammer here in my area, and then it made new high, I'd say tick. I've got my area, I've recognized the change of trend, I've done everything I wanted to, and I can be trading a 15-minute time frame potentially, doing a bit of a day trade, yet I'm doing analysis on the bigger time frames because I've used the bigger time frames to find the key zones. I think the big problem with scalpers is that they're just shorting and buying and shorting and doing all these types of things, but they're doing it here in the middle of nowhere. The higher probability is to create your range and to go with the larger money flow. And guess what that allows you to do also? It allows you to say, I might be in on a 15-minute trade here, but what I can do is I can put my stop loss here and my take profit all the way up here, or some of it. So I might say take some off here, I might leave the rest on, and I'll take it towards the next resistance on the larger time frame. And I can do that, and then I might have a 5-to-1 trade. I might risk $100 and make $500. Well, that's pretty good. And I can do that because I've used the larger time frame to figure it out. Whereas on the smaller time frame, you might be constantly risking $100, taking $70, or risking $100, getting out of a trade with $30, and then getting some trades with $150 and that type of thing. You won't have a great idea of where the trend is really going. So hopefully that does make some sense. There's a few questions that are coming in.
Yeah, I'm answering a lot of them as best I can.
Okay. If any of them are so massive, it's just
I'm answering them as we go. But look, if there's any that I think will help the room, I'll actually say them out loud. So
okay, no problems. There were some big questions, so thank you very much for asking them, and we will try to get back to them. So what market conditions do we generally look for in terms of the economic pillar? Well, the first one we do is, of course, non-farm payrolls, key economic news. That one generally will be what we're looking at. Now, right now, non-farm payrolls doesn't mean as much, but any of the red news on any economic calendar, I believe Pepperstone have one, they've got one as part of the advanced tools as well. If it's red news or high alert news or high impact news, that kind of news you want to look at. In particular, though, as I mentioned before, it's all about the speeches and all about probably the GDP and then also the interest rate decisions. They're the ones that are the biggest keys in terms of the largest moves generally. We also say that Mondays, if you're trading a trend, can often be fake out days or kind of a day where the market takes a relaxation and does maybe a bit of a pullback or something like that. And that's because think about it as Mondays generally have public holidays on them and bank holidays. So this Monday, we saw a lot of fake trends and a lot of things not setting up correctly. And guess what? It was a bank holiday in the US, and I believe the bank holiday also in the UK. So it makes sense that if you have major forex markets not trading and bank holidays, there isn't going to be that much range. So make sure you're aware of that. And of course, the time of year and the volatility in the current markets. If you're trading end of December into start of January, I would urge people to basically have stop losses in their trades all the time, and just to be careful because there can be illiquidity events that occur. And if you ever want to see one, I believe it was last year in January, there was a large spike on most currency pairs, and that was the illiquidity. So Ty, before we get to risk management strategies and a few other things, just want to reiterate the Discord. And I also want to let everybody know that we do have a live webinar event straight after this one, about 15 minutes after this one, where we go through the live markets and have a look at all of the current markets and what's going on in them. So if you're interested in that, make sure to definitely join us and check that out, because we do that every week as well. In terms of risk management strategies, Ty, it's not really one of the 3 pillars that we're talking about tonight, but it should be definitely a pillar of your business strategy. And that is to always try to get a reward of over 1 to 1. So if you're risking 100, try to always make $100 back. If you're not doing that, unfortunately, statistically, it won't generally work out over the long term. When it comes to risking, how much should you risk? Everyone's always going to say 1 to 2% of capital. I know some people risk more than this, but you've got to think of it this way. If you lose, let's say 50% of your account, you start with a $5,000 account and you go back to $2,500 because you've risked too much. How much do you have to make to get back to 5,000? 100%. And that's not maybe what you're thinking, but that is what you have to do. So you really need to think of this as a long game. Trading is not a get rich quick scheme. Everyone comes into it thinking, how easy is this? I buy, sell. It's just not that easy, okay? It takes time, and you've got to spend a lot of time in front of the charts. You've got to educate yourself. You've got to find, maybe if you want to jumpstart that, find a great educator that you like and that you believe in. And if you want to do price action, definitely check us out. I'd recommend us. And many people, of course, on Google and everything would, but that type of thing, it's very important. You can either kind of speed up your learning curve, or if you want to do it yourself, you will make generally the same mistakes as everybody else. And that's why you'll find a lot of people say, oh, I made every mistake in the book. The idea is that you try not to do that, and then you get there faster. And I think some of the information out there today is great, but as someone mentioned in the comments before, there's a lot of Instagram, a lot of get rich quick. I've got a Lamborghini, and I think in crypto it was very key with that kind of thing. That is a problem, because it really is not that kind of thing. When it comes to trading, you can't just make, I mean, you could make $1 million in a week. It's possible, but that doesn't mean you can keep the $1 million. And that's why you don't hear of too many people doing that and keeping the money for the long term, because to get that mindset that got them to the $1 million in a week is their undoing eventually. And Tyron, you can attest to this. How many people have we known over the years that have made huge money really quickly, and then 3-4 weeks later they go quiet because it's all over?
Oh yeah, no question. And look, most of the time, like you gotta not get sucked into, watching people load up their Lamborghinis with trading. I saw one today. I mean, I just find it amusing actually that people still believe that. It's just unbelievable. Yeah, like you really got to look. You've got to think to yourself, straight up, like straight off the bat, if they're really showing off their Lamborghinis or their Ferraris, are they really, theirs? Are they they're only hiring them for show. Unfortunately, they still catch people. Like they prey on the people who are desperate for that golden chalice, or that magic, whatever it is, signal that's going to give them the same success. But the truth of the matter is, it's work ethic and following simple rules that gets you what you need to do. You're not going to be driving around in a Lamborghini and trade a $10,000 trading account. If that's your balance, you're not going to make that $1 million. So don't ever think that you can. I know they try to advocate that. It's just not going to happen. And if it does, it's by some monumental fluke, and it's not something that's going to be repeatable. The thing about, you know, technical analysis and following the rules, it is a repeatable process that you continually do, and when you do get good at it, you start to see the same things happening over and over again. But it's not a get-rich-quick scheme. There's just no way that you can do that and actually sustain a positive, you know, result table every month, like month on month. You've got to do it correctly. But will it give you potential wealth creation ability? Absolutely. Can you make an extraordinarily good living from it? Absolutely. But you can only do that when you start out the right way. So don't get sucked in, you know, to the get-rich-quick, big signal services and the fancy Ferraris, because it's just not right. It's not the way it works.
No, it isn't, Ty. And as we said, take this one thing away from 3 pillars. If you want to ignore everything else, have a business plan. Write it down. I was actually talking to somebody, it's completely not anything to do with, actually to do with making YouTube videos. And I was making some YouTube videos in terms of financial stuff. And I was thinking about how is the best way to script this? And I went back to being an essay plan. Do I write the whole script? No, I kind of understand what I'm going to say anyway, but I write the key points. And that's the same thing as having a good business plan for your trading, or the same thing in having any business plan. When you come up with an idea, you've got to map it out. Most people just jump in nowadays. They're like, instant gratification, let's go. It's not going to work, I can tell you. And that might sound like preaching, but it's very, very important that you have a plan. Obviously, in our course, we have the Presic plan. Now, the Presic plan is now part of the Foundations course in terms of you can go in there, literally select all of the things that are part of the actual course themselves, and then select which ones you're seeing, and then it will spit out a score to you. So it's quite a great system. Obviously, that's our business plan for doing things, but it is important to understand that. So look, to summarize today, we'll go back to all the way to the start, go through those questions. And I think the key is when figuring out a trading theme, US dollar index first, VIX, US dollar index, and then I would go to the majors, the euro, the pound, US dollar, and maybe the one that you're looking at. Why economic news impacts and moves currency pairs? It's all about each bit of economic news coming out, whether it's bad or good for the economy, will impact the monetary policy and the interest rate decisions. And from that aspect, that will change the price. And I urge everybody to understand when interest rates go down, something technically is going to be happening. When interest rates go up, something technically is going to be happening. Everything's a little bit different now because of quantitative easing, but in essence, that's what it is. When it comes to technical patterns, make sure you're using horizontal technical patterns as much as possible when you first begin. If you're an intermediate, I still recommend go back to them, ignore things like flags, and just don't use them, okay? They're great patterns, but you're going to come into trouble. Trend lines, very dangerous as well. So horizontal, 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 don't FOMO, and of course, stick to the rules as much as possible. So hopefully that helps. I will answer a couple of quick questions here, but it does sound like we've had some sound issues tonight, and we will have a recording of this. We'll put it on YouTube, and hopefully everybody can listen to it then.
Yeah, a lot of people are actually asking about the next webinar after live market analysis. I'll pop it in the chat window again, just for the people who didn't see it. But if you don't get it, just send the question and I'll pop it into your inbox on the thing, if you can't see it in the chat window, but it should be there. So we've had a few requests for people wanting us to look at the live markets, but yeah, this is a teaching webinar, but we'll definitely do that in the next one that starts in 15 minutes. So there's no issue there.
Someone says here, flags are great when you have a Lambo and an Instagram account. Yeah, pretty much, yeah. Yeah, flags are good actually, but they're very, very tough. Like they really are tough. They involve you knowing a lot about Fibonacci. They involve you knowing about market dynamics, key areas, and really understanding the multi-time frame analysis. So horizontal would be my key.
All right.
Is there any other questions here, Ty, that you've answered so many, but there's some good ones. Anything here that stood out to you that you were like, wow, it's worthwhile answering to the group?
I'm just scrolling through. This is probably a good one for you, Thomas. It's does the VIX show volatility on the dollar index or all currencies?
The VIX is technically, so if we're talking about the VIX that you usually see, it's based against the S&P 500 volatility. But in essence, everything is linked to, to a degree, to economies. So if the volatility is high in the S&P 500 in the general market, the fear is there, that will change the way that people expect the central bankers to potentially react. Now, remember, volatility equals uncertainty in the economy. If we have uncertainty in the economy, that could mean interest rate cuts. That could mean monetary policy. That could mean all these types of things. So what we saw recently, where obviously we had this virus outbreak and everything went crazy and the volatility came crazily into forex, it was there just like it was in the stock market. Things were moving I think it was almost 1,000 pips in like a 2-week process. So there was huge amounts of moves, and that's why the VIX is so important. Look, I'll post both these Telegram and the Discord room in for everybody. I hope this webinar did help everyone as much. We've got a couple of things here. If you have time, why are trend lines considered dangerous? Yeah, I'll answer this. Ty, could you just put in the Discord and Telegram room for everybody? So let's say we have price doing this, okay? Now this is a really good trend line because it's touching quite a few times. The problem is this is what people will generally do. They'll be like, all this crazy looking price over here, and they'll draw a line and they'll say this spot connected with this spot, which connected with this spot, so therefore this is now a key area for me to trade. It's not. It's a coincidence, but how is that something that someone's placing millions of dollars of trade positions on? So you can get some pretty serious lines going on everywhere. I see it all the time. The other thing as well is if you're looking at a trend line, you want to make sure it's all clear. So it's all very clear to you, and it has to be incredibly clear to you. Often what people will do is you kind of draw a line to fit your own purposes. Horizontally, it's a lot more clear cut, so you won't generally fit it as much. You might say, oh, well, this one broke through like that, but it reversed or something like that. It doesn't really matter. I'll ignore that. Okay, you can't ignore this. It's not possible to ignore this, but you will. So I think trend lines take a lot more. There's a lot more kind of ambiguity to them, and the ambiguity means that you can't be consistent. So hopefully that answers it.
Brilliant.
Someone says, your trend line you drew there is funky. Well, that's unfortunately what you usually do see.
Yeah, it is. Yeah, it is. All right, perfect. Well, I think that pretty much brings us to a close. So hopefully everybody will we'll see everybody in 10 minutes to do the live market webinar shortly. And yeah, hopefully if you have any more questions or anything that you'd like us to cover in the future, just send the support crew at Pepperstone a message on what you would like to hear more of or what you would like us to focus on, and we'll try and get as many of those together to get everybody the best experience they can. So we try to cover the topics that are going to be very useful to you. So feel free to touch out and reach out, to Pepperstone, let them know what you would like us to talk about. And yeah, we'll certainly try to squeeze them in the next webinars.
All right, thanks very much, everybody. We will be doing, I think we're back to our fortnightly video webinars after this week. Is that right, Ty? Next week, I think we're going to.
Yeah, I think the next one.
I think start next week we will be 8th. So I think.
Yeah, the next one will be on the 10th of June. So keep an eye out for your invitations, and if you haven't got any, maybe just reach out to Pepperstone. But the 10th of June will be the next Pepperstone webinar.
All right, well, we wish everyone happy trading, and obviously have a great rest of the week and stay safe out there. Thanks very much.
Thanks, everyone. Good night.